mailbox money, right? We all talk about passive income, but reality is most things are semi-passive that people are talking about when talking about passive income, with the exception of being an LP in a private equity real estate syndication. Hi there. How are you?
Good. How are you, Kristen?
Excellent. Thank you very much for joining us tonight.
Of course, very excited to be here.
Yes, well, let's go ahead. As people are hopping on, I'll go ahead and introduce you, and we'll kind of dive into the topic at hand and get to learning. I know everyone's excited to hear what you have to share about syndications in general. So, this is Christopher Parrinello. He has extensive experience in the private equity space, in the syndication space, specifically with multifamily investing, and he's actually the vice president of investor relations for Viking Capital, who is a private real estate company that does large multifamily in the Sun Belt, in Texas and in other markets. So we're very excited to hear from you. You are obviously incredibly experienced in this arena, and I'm sure we'll all learn a ton.
Yeah, no, absolutely excited to be here. I think, my background and especially Viking Capital, I think is a good case study for your audience because our principals were physicians who started the company, which is
That's what I heard. Yeah. Very cool. So tell us a little bit, like, how did you get involved in Viking Capital and how did you get involved in the space in general?
Yeah, absolutely. So I'll give you a brief background, my brief background, which I started in real estate private equity about 10, 11 years ago. And I was focused on hotel development in Southern California.
Okay.
And the majority of capital that I was raising was overseas capital. It was through the EB5 program. And I was fortunate enough to have really great mentorship from a couple folks in Southern California that were really involved in economic development and were seasoned real estate investors. So great mentorship kind
Yeah.
of led me to a role that I had just before Viking with a group called Pia Residential. They do what Viking does, but they only focus on institutional capital. So think family offices, RIAs, ultra high net worth. And
Okay.
towards the tail end of my time with Pia, I had this idea where I was like, I think we should have a new kind of tranche of capital. And I think we should go out to individuals, your typical high net worth doctors, lawyers. The industry calls it retail capital. And it was a popular idea, gained a lot of traction. And I was like, in 2012, when the rules kind of changed with crowdfunding and the Jobs Act, it opened the door to give this opportunity to your everyday investor that was accredited. And while it was a popular idea, it that company didn't kind of see the vision of how that they felt like it would make them look less than to brokers. So that kind of was my pivot point. I was a little bit bummed out. I was really excited. I love the idea of teaching about real estate and helping folks understand how these projects work instead of walking into an investment committee and just getting slammed by, MBAs that are way smarter than
Yep.
me. So, I had a passion for the everyday investor. And when I met Vikram and Ravi, the two principals at Viking Capital, they really loved the vision they had already started. And they had come from a place, to give you some background on Viking, they started the company in 2015 and they did it almost how you would expect two physicians to start the company. They were investing passively themselves. They knew real
Yep.
estate was a decent investment. They realized the power of scalability, which was something they weren't finding in traditional equities.
Yep.
And over a few years, they just kept pouring more of their time and effort into it
Mm.
until they decided they wanted to learn more. And they started bringing swaths of capital to
Yep.
sponsors that they had built relationships with and learned kind of from the ground up from some of these folks. And then around 2018, 2019, ambition and a nice group of investors that were backing them and a market that was very favorable was the perfect
Yeah.
opportunity for them to really scale quickly. So all the way through, I'd say 2021, they were kind of
Mhm.
able to ride this wave of being able to really, well, to date, we've acquired just over $1 billion worth of assets.
It's incredible.
In 2021, they realized, oh, we're getting quite large and we're buying these institutional 2, 3, 400 unit properties.
Right.
They started developing their team. And that was one of the things I really respected about them.
Yep.
They understood what they didn't know or weren't experts at, and they started poaching people from institutional firms that had the background and the track record to
Yeah.
help stir what they've already had learned themselves. And not to say that there weren't bumps and bruises along the way. The market kind of took everyone by surprise when the interest rates shot up in
Yeah.
2022. Um, but I think the thing that they did really well was building their team and building the infrastructure and the way they go about managing all the great minds that they found. So
That is
I've been
such
really
a cool
good.
story. Do they still practice? I have to know. Or are they totally on the sidelines medically?
So Vikram has a coaching business called Limitless MD.
Uh-huh.
Um, and that is, he spends, I'd say, 30% of his time there. His
Okay.
main focus is Viking, doesn't
Okay.
practice medicine anymore. Ravi was out of medicine for quite a while, but
Mhm.
found that he was still very passionate about it. He's recently started a medical practice that's more, I think, like health and longevity.
Yeah.
He picked the thing that he was most passionate about and was like, I have to be spending at least 20, 30% of my time doing this
That's
because it's
awesome.
important. Um,
Yeah, that's so cool. I think, and what you said too, it really rings true. We have a saying in medicine of you don't know what you don't know. And I think it sounds like they have mastered that in this arena as well and have like brought in a whole team of experts to maximize what they were able to do. And that's, of course, why we're all on events like this to learn stuff because we don't know what we don't know. So that's incredible. And honestly, it's really cool to see people in medicine stepping out and becoming experts and doing non-medical things very, very, very well.
Yeah, and I think that's one of the reasons why I felt like I was a great fit because I
Yeah.
was yearning for an opportunity to really help folks understand. And what you'll notice, in the community that you're building, the one that we've built at Viking Capital, just since I've been there, we've grown our investor base from about 275 individual investors to over 1,000. The difference between working with institutional groups and real people
Yeah.
is, you're really building friendships and long-lasting relationships with people who are investing their savings to help grow their wealth alongside you. And it's
Yeah.
just a completely different vibe. That's just it's much better in my opinion.
I could see that for sure. Well, I think in the world of personal finance, there are very few things you can do that are real deal mailbox money, right? We all talk about passive income, but reality is most things are semi-passive that people are talking about when talking about passive income, with the exception of being an LP and a private equity real estate syndication.
Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing. With a team of seasoned real estate experts, Viking Capital conducts deep financial analysis and data-driven asset management to deliver outstanding returns. Their strategy focuses on low-risk opportunities with significant value-add potential, preserving your capital while maximizing long-term growth. Join them and be part of a success story. Viking Capital has acquired 30 properties and manages over 6,000 units, all thanks to their dedicated team and valued investors. Discover their current deal offerings at vikingmultifamily.com and start your journey to financial freedom today.
So there's obvious pros, but give us just a 30,000 foot view of someone's listening and they're like, I'm not even really sure what it means to invest in a real estate syndication. What are the big picture pros, the big picture cons?
Yeah, I'd say that the general concept is that I'd say you're passively you're getting returns passively, but there's still amount of activity and an activeness to it because really where you're spending your time is building the relationship and vetting the sponsor.
Run it, right?
Understanding their
Yeah.
track record. Our rule of thumb in my department with the young folks that I mentor
Mhm.
is if somebody doesn't understand how the deal works, they're not allowed to invest with us. And
Mm,
I think
good
that
rule of
there's that level, and not every group is that way. Some people feel like I go to a financial advisor because they know what to do and I don't, and I'm trusting them to make good decisions on my behalf. I would caution everyone with whatever sponsor you're working with to at least understand the framework of how the deals work, where the risks are associated. But if you find a good sponsor and you build a level of trust and you do the hard work on the front end, then there is a repeatable, rinse and repeatable model. Whereas this sponsor is buying deals over time, there are going to be parts of the cycle that are very lucrative and parts that aren't so great. And some of that's out of everybody's control. But generally, it's a good market to be in. And if you're following the super trends in real estate, population growth, economic growth, you really have a nice high ceiling with a very, very high floor, where the goal is that if you're working with a reliable sponsor, that the floor is you get your money back and you didn't get much of a return in a down market. Now, of course, there's always the risk of losing all of your capital, having to put
Right.
more capital into deals, which everyone should know. But it's in my opinion, the risk-adjusted returns is how we'd refer to it. Outpace that of traditional equities and should certainly be a part of everybody's portfolio.
Yeah. So I'm going to go just even like very much more simple than that, 'cause you're obviously an expert in this, and I know we have people listening who are like, this is my first thing ever on syndication. So if you're wondering, like very, 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 very top of like overview, these are huge multifamily properties that they're buying that are hundreds of millions of dollars. You or I, as an individual investor, can never go and buy this property. And so you can invest as a limited partner. You don't have any operational capacity as an LP. You're not like vetting tenants. You're not doing the value. You're not doing any of that. The sponsors and the GPs are doing that. And you, as an investor, will do your due diligence on the front end to go, hey, is this a good investment? But then once you invest your money, your work kind of ends there, right? You'll get your cash flow distributions at some point. You can get your return of capital, but once you've set this whole thing in motion, it is kind of a true passive investment. As you were mentioning, there's a couple of big risks. One of them is risk of capital loss, and then the other one is a capital call, which you kind of alluded to as well. But the returns have the potential to be really high, which is why people are really interested in these deals. And if you're a busy medical professional who doesn't have time to like go out and, buy a short-term rental and manage an Airbnb, for example, can be a really cool avenue for bringing in that asset class without you having to go like take the call on the toilet that's broken in the middle of the night. So that's a big upside for a lot of medical professionals. But I think one of the big downsides is that if you don't have any experience investing in real estate, even like, small multifamily or single family, a lot of the terminology can just be like very overwhelming. Even if you've done residential, I think just learning the commercial terminology can be confusing. So give us an idea of like when you're going, like let's say that you're going to listen to a presentation and learn about an opportunity to invest in a deal like this. Are there key metrics that you should kind of have your ears perked for or try to understand what they mean so that you can feel like you have a little bit of an understanding of how the deal is structured?
Yeah, I'd say the big ones, and I've walked a lot of investors through our model. So like just understanding the word performa is basically the financial model that is built for us internally to decide whether we want to do this deal and at what price. And that's important because what I've seen is that a lot of folks that, and not everyone is, every sponsor is as sophisticated as the next. And a lot of times what you see is people will present a deal that is very flashy. We have a beautiful deck and beautiful pictures and all of that, but
Yep.
it's very important. If there's one caution I can give all of your listeners is when you're evaluating a deal, like there are hard and true numbers in this financial model that explain how the deal works and asking for that and looking at that. And if you don't understand it, finding someone to help explain it to you, if not the sponsor themselves. So that would be like rule number one. The big terminology in there that I think is going to help you isolate and evaluate risk, which I think is the most important part of evaluating one of these deals. Like don't get hung up on picking the best returns, but
Yeah.
finding the least risk and still having nice returns.
Yeah.
So what I always coach people on is go to, the cash flow section and find out the DSCR, The DSCR is the debt service coverage ratio.
Mhm.
So that your biggest risk of one of these deals, think of it this way, the biggest investor in the project is the lender. And people don't think of them as an investor, but they really are. They're putting up 70% typically or so of the purchase price. So the way that an investor, an LP, is going to lose their money is if that lender doesn't get paid. And what DSCR measures is the amount of cash flow in relationship to the debt service or their mortgage payment. So that being above 1.5
Mhm.
is typically, something that you would see as safe. And then the other big piece is what type of debt are they using? So that's another common, is it variable? Is it fixed? Is
Right.
it with an agency, which is the government agencies, Freddie and Fannie? Those tend to be less predatory. There's some debt funds out there, they're kind of hoping that you fail so they can take the
Right.
property and wipe out all the equity. And then other big things in the model that I think are important that people need to understand from a return perspective are IRR, internal rate of return, ARR, average rate of return. Those both measure the amount of return that you're getting. One takes time into account and one doesn't. And then you have cash on cash, which is that distribution, the mailbox money, as you put it, that you're expecting on a monthly or quarterly basis.
Yeah, that's super helpful. Now, just a question for you. Would you consider if someone's using variable debt and there's like no rate cap, would you consider that a deal that you would walk from? Or would that not be, would that maybe be like a yellow flag for you and not a red flag? I'm just curious.
I'd say yellow flag. I'd want to learn more. So the
Okay.
argument for variable rate loans, and Viking has some of these in their portfolio. I
Uh-huh.
think with hindsight in the timing, now that we know what has happened,
Right.
even with the rate caps, we probably would have structured them differently.
Hmm.
But when you're in an environment where cap rates are compressing, so cap rate's another one of those terms which kind of measures it's the way the market measures the exit pricing in relationship to net operating income. So when there's a lot of competition in the market, cap rates are compressing. And it makes sense because if there's a lot of competition, people are willing to pay a higher price. So a few years ago, debt caused cap rates to compress because it was so inexpensive. People could model these deals out and they could create really great returns because the biggest cost of capital for 70% of the deal was at 2.5% or 3%.
Right. Yeah.
So with a variable rate loan and a cap rate compressing environment, the argument for variable rate debt is if am only planning to hold this for 2 or 3 years, then I can sell it without paying a prepayment penalty. And that was a valid
Yeah.
argument. So if you were buying in 2018 and you sold in 2022, you had a
Uh-huh.
variable rate loan, you probably look like a genius. If you bought in 2021 with a variable rate loan with
Yeah.
a 1 year rate cap and then didn't sell in 2022, you're riding the struggle bus to a certain extent. And real estate it's safe if you know what you're doing because even making that mistake, what you end up having to do is to restructure, renegotiate with the lenders, buy more time, and what you lose is time. If you can't pay your debt service and you didn't have a plan, you don't know how to navigate it, you could lose the property to the bank.
Right.
But in this time, looking at the trends in the market now, you have a lot of uncertainty. And you have a 10-year, which is the benchmark treasury, that is erratic because no one can quite tell what's going to happen next. So a few weeks ago, it was down to 3.8. Now, today, it was at 4.4. Last September, it was at 3.5. In order for cap rates to compress again, you really want to see a treasury market that has stability and is kind of eking back down to normalcy. It's never going to get down to what it was, which was zero, like coming out of COVID. But I mean, one day it will, but not anytime soon. But
Sure.
what the commercial real estate market is craving is some stability where it gets down to 3.5, and stays there for a decade. And then everyone can plan and predict and forecast properly.
Yes.
Where I would be worried about a variable rate deal today
Uh-huh.
is you could have rates coming down. I've seen sponsors make that argument, like, well, rates are definitely going to be lower in a couple of years, so I'll use variable rate debt. But, a lot of big economists think that maybe 2 years from now, we're facing stagflation and we're seeing even higher interest rates than we were before. And if that happens and you're using variable rate debt, you're in trouble. So Viking personally is not using any variable rate debt right now.
Okay.
And what I think most tried and true sponsors typically do is
Yeah.
they will use a 7 or 10 year Freddie or Fannie debt instrument because it's very easy to look at real estate and say, wow, I'm going to double my money very quickly. But people that have been in this business for 20, 30 years are saying, I would like to reliably double my money over some period of time with as much flexibility built into my business thesis. So
Right.
the smart people in 2021 and 2022 that were around in 2008 put 10-year fixed rate debt at 3.5%. And
Hmm.
today, instead of trying to negotiate with a lender, they're
Right.
selling their deal 5 years in with a 3.6% loan assumption and making a nice. So that's kind of the difference just between using those debt structures.
That's very helpful. And I think it reiterates one of the key things I kind of wanted to talk about next, which is that as the LP, you don't have necessarily like any influence over these types of decisions, which really highlights the importance of having an excellent sponsor and really vetting a sponsor well so that you ensure that they're someone who is taking like reasonable, not unreasonable risk, is seasoned, etc. And so I want to just walk through like what that process looks like. I think there's some obvious things, even if you're like, I've never invested in a syndication before, and you speak to someone and they're like, this is my first deal. Like, okay, well, we lack seasoning. But I think even beyond that, like having a recognition of how many deals has this person done in this asset class size, in this market, and how many of those deals have gone full cycle? Like, those are the questions I think most people would maybe intuitively think to ask, but you obviously know there's more to it than that. So if you were going to take a little bit of a deeper dive into what does it look like to vet a sponsor, where would you head with that?
Yeah, I mean, I think, and I did this before I worked for this company. And, when I'm talking to anybody that I'm looking to invest money with, whether it's a financial advisor or someone that I know that's doing an active real estate deal and is looking for capital from friends and family, you always I always like to first make sure that I know, like, and trust the person that I'm dealing with, because if you don't know, like, and trust them when nothing has gone wrong, inevitably, when you invest in real estate and you do it long enough,
Yeah,
even the best sponsors are going to run into adversity. There's a reason why we create this and make it passive and we get 30% of the promote for doing all
right.
of the work. It's very
Yeah,
challenging work. And there's fires and hurricanes and
yeah,
tenants that don't want to pay rent. There's a lot of things that could go wrong, and a lot of the what you're building the use case for one of these acquisitions is built off of 50 different assumptions. And those assumptions can come true. They can be conservative or not. So I always start there. So when I'm talking to somebody and when I'm training my team from the other side, like you're talking to an investor that's never done this before, I explain to them, you need to help them understand how this works. You need to help educate them and never put any pressure on people, because ultimately it's you can luck out and find a good sponsor that does a really good job, but
yeah,
until you really understand some of the nuances of how the deals work, really the dream situation for us as a sponsor is that the expectations are clearly set with the investor so they actually understand how things work. So I start there. Know, like, and trust. Make sure that they're willing to go through the materials with you, that they're not pressuring you to make a decision, because there are going to be opportunities where you might miss out on a deal because it fills out really fast. But if somebody's like, if you don't sign today, then you're never going to be able to invest, like that would be a
yeah,
red flag. And usually it's the people that that care about doing the hard work to help people get educated along the way, you'll notice that those are the people that you want to work with. The other advice that I'd give, and this is something that, we ask investors to take advantage of even without them asking us, is
Mhm.
look at the reporting packages. So even if you're not in one of their deals, ask them, say, hey, can I see your last monthly report for a deal that's going well and one that's going bad? Because everyone has, at least in this day and age, has at least one deal that's challenged.
Right.
Um, and then take a look at what that reporting looks like. Do they provide the entire financials? Do they have any kind of breakdown that's helping, more novice investors? Like, we had a bunch of investors come to me and they were like, Kris, like, you're giving us all this information, we don't understand it.
Yeah.
So I went to our asset manager and I was like, hey, we have this issue. Let's find a way to solve it. And now we do like a 5 or 10 minute video every quarter explaining the package that we're sending out. Things like that, I
Yeah.
think, are important when you're not dealing with institutional capital and you're
Yep.
being flexible with the people that are investing with you so they can be involved, because that's what you want as a sponsor that has longevity with investors that are more on that more retail base. Is you want them to feel involved and be excited about what they're invested in. And that's what I'm usually looking for as an investor as well, is who cares and picks up the phone and makes time for you. Like, I usually, if there's a new investor that's never invested with us, one thing that I always like to tell them is, if you're dealing with another sponsor, that's okay. If you want to send us any information to help you evaluate it, like, we wouldn't expect you just to invest with us. Diversification is very important in
Sure.
investing,
Right.
and also testimonials. Most sponsors would feel comfortable giving 4 or 5 numbers to investors that already work with them. And you'll want to know that they have, some raving fans out there that they can provide feedback on what it's like to work with a sponsor.
Yeah, that was great. And I think a lot of that is, yeah, someone's willingness to recognize, hey, I am an individual investor, like my expertise is in medicine or law or whatever else, and it's not in commercial real estate. So rather than like be like, hey, next Tuesday's your deadline. If you haven't wired the funds, you're out forever. Having the willingness to step back and do a little bit of education is really helpful for helping people feel like they're making an empowered decision. Because even as an accredited investor, which we still need to talk about, by the way, it's
Yeah.
still a big investment for most of these. Like, it's a
Right.
relatively large sum of money. And so feeling like you can do that with confidence, I think is tricky. So let's talk about minimum investment for that's common, just general rules of thumb. But before we do that, will you just run through, you mentioned it earlier, what's it look like to be officially an accredited investor so that you have access to most of these deals?
Yeah, these rules are ever changing. So typically, and the way it's been for the last several years, is if you make over $200,000 a year individually, or you make 300,000 as a couple, you would hit the accreditation threshold. You also can qualify by having $1 million of net worth that isn't including your primary residence.
Yeah.
So that's the net worth standard. There's also ways to qualify through professional status now. That's one of the new things that has popped up. So if you're a VP at a bank or a private equity firm that focuses in some other asset class, but you understand how to read a PPM and you understand how these things are structured through the role that you have at another company, that will allow you to be an accredited investor. And then one that I'm not too familiar with, because it really just happened in the last few months, is there's investment amounts now. I think it's if you invest over 150,000 or 200,000, you still technically have to be accredited,
Okay.
but you are able to self-certify. And that's one of the new rules that has just recently
Interesting. I didn't even know that.
come.
Okay.
And
Huh.
it's tricky for the sponsor, because the sponsor, if you're doing a Reg D 506 offering,
Uh-huh.
the the SEC is really looking to protect investors. That's why these
Yeah.
accreditation rules exist. So
Right.
they're trying to make sure that sponsors aren't predatory over investors that don't understand how the deals work. At least
Yeah.
that's how they frame it. So now I think what they're trying to introduce is, if you're able to invest this sum of money in
Mhm.
one fell swoop, then you can self-certify that you're accredited, and the sponsor is no longer responsible for forcing you to generate an accreditation letter by your CPA or through something like parallel markets.
All right.
And then I've heard recently that there's a lot of push to have like a licensing test, almost like a Series 6
That's,
kind of
yes, that I have heard, the
test, but
build
that's
case
not
and
happened
structure.
officially. Yeah.
It does like make intuitive sense because realistically, the whole point of the rule is to say like, hey, I understand how to do due diligence on these deals. Like I'm a sophisticated investor, but having a high income does not equate to being a sophisticated investor. And so it's like, it does seem like maybe that would be a nice option. I've heard that was in the pipeline, but I wasn't sure when that was coming to fruition.
And I can attest after speaking with thousands and thousands of investors that there isn't a correlation to the investment size and the sophistication of the investor. The
Like, I'm
largest
sure.
investors that we have,
Yeah.
when I started talking to them about the deals and I was just meeting them, I'd go through the underwriting with them and they were like, no one's ever done this with me before. I was like,
Yeah.
you're in 50 of these. What are you talking about? Like,
Oh wow. That's crazy. So give us an idea, like if you said, hey, I would like to add this to my portfolio, most of these type of opportunities do have a minimum investment. So what kind of range would you expect?
yeah, I'd say usually it's 50,000 and up. With our company, we tend to have a relaxed, like first time kind of we'll cut it in half if
Yeah.
somebody wants to dip their toe in
Yeah.
and see what it's like. But for the most part, most sponsors are at a 50,000 minimum, and they'll usually have, or a lot of groups will have tiers within their structure to allow for more participation on the promote for larger investment sizes.
Yes. I was that was what I had in my mind was 50 to 100,000. So yeah, it's it's a big investment, especially if you're someone who hasn't done any type of real estate investing at all whatsoever, then maybe all what you're doing is like dollar cost averaging into index funds every Friday. At no point are you wiring someone 100 grand. And so it feels intimidating. And the funny thing is, the first time we did, we had already bought like physical property and stuff in the past. And even though maybe dollar amount wise it was not the most we'd spent, it still felt very different because there it lacked the element of control of
Right.
like being able to feel, touch, taste like this is what we just bought with our money and we can go visit it or whatever.
Yeah.
Um, with this it felt a little bit more nerve-wracking because it kind of felt like wiring money into the abyss, which
Right.
of course it's not. It's like it's a very valid investment modality and we've had, great success, but it does, I think there's an emotional aspect to feeling comfortable like really investing that much money into something that you ultimately don't manage and don't have control over. So how would you help someone navigate that piece of just being a little bit nervous? Maybe they've done all the due diligence, they feel confident with the sponsor, but they're like, I've never done something like this in the past.
Yeah, usually that the way that we solve that problem is we try to reduce the minimum, and we'll usually over communicate, jump on Zoom calls, go the extra mile. In a lot of cases, we're a big enough company where I try to go and meet with a lot of investors. So we do investor events and we tell them, we're going to be in this city. If you're
Right.
feeling a little bit nervous, come, let's meet in person, let's chat, let's talk about it more. And it's really just if you've done your research and you understand the deals and you understand the non-liquidity, because I think that's something that a lot of people overlook. But sometimes these deals range from 3 to 10 years,
Yeah.
and knowing that you're not going to have access to that money for 3 to 10 years, you'll you'll usually get through a couple of them, find quite a bit of success, and realize that sometimes it's more of a pain to find where you should put your money than finding good investment opportunities and having your money work for you in those areas.
Right.
People usually also, once they get the tax benefits, if they have other real estate ventures like active investments and things like that, that's usually a big reason for people to jump into the space.
Yes, nice bonus as well. Everyone's always up to improve their tax situation. So if you're not familiar at all, give us the rundown. Like, what does a cash look like in terms of, like let's say you invest 100,000. what is the typical period of illiquidity, as you mentioned? I know you could never promise rates of return, but give us just sample ranges of like how does it work in terms of cash flow distributions? How does it work at the end of the period where you're illiquid? What's the flow look like?
Yeah, typically with an acquisition deal, so you're buying something that already exists, you're usually going to get somewhere between 3 and 5% annually. And then based on the performance of the project, you're hoping over, 5-ish years to get around, I don't know, a 1.7 to a 1.8x return. So it equates to about, on an average annual return basis, I think I always look for deals that are going to land in the low to mid teens. I'm usually cautious of deals that say that they're going to get 18 or 20 or 22% because usually there's some financial engineering in there because internal models with real estate companies and where properties are trading at, it's really hard to find a deal that's really going to truly
Yeah.
conservatively produce a low 20s IRR
Yeah.
unless you're looking at development. And development's different. So in a development deal, the upside is you're getting a compressed timeline, but you're not getting the cash flow because the property doesn't exist yet. There's no revenue. So the way that you're thinking about the cash flow is when we buy the property, that distribution that you're getting is really the excess cash. And typically, the sponsors might have a small asset management fee, but all of their returns, all of their profits are coming when we sell the property. And that's important because what that creates is alignment. There's some fees, and they're on the front end and the back end of the deal. And then there's the carried interest or the promote, which is what the investors or what the sponsors are really hoping to get, and that's 30% of all the profits. And that's one of the reasons why it's lucrative to be an LP, because when
Right.
you're an LP, even in a minimum investment scenario, you're typically getting 70% of the profits from the deal. The sponsor's getting 30%, and that's basically their sweat equity that they put into the deal. And then they might have, 10% of the total equity in the deal as well. So when that property starts taking on revenue and it pays all of its expenses, that extra cash that's sitting there is what creates that 4, 5, 6% return. The liquidity for a development deal is usually going to be 3 to 5 years, and the illiquidity for an acquisition deal is usually going to be 5 to 7 years, unless you get into this environment where cap rates are compressing, and then people will take advantage of the competition and sell sooner than they modeled it out for. At least that's the way it's supposed to work.
Right. No, that's very helpful. That's very helpful to understand. And you guys specifically are in very large multifamily. So tell us a little bit about like the multifamily market overall, you've already talked a little bit about what we've seen over the last few years. What do you anticipate over the next like 5 years? Obviously, I know you don't have a magic 8 ball, but kind of what are your big picture estimations of what that will look like?
Yeah, so it's you got to remember that the market is cyclical. So you had kind of a bull cycle, and that was brought on from the great financial crisis, the GFC, 2008. Things just kind of linearly went up all the way until COVID. COVID created, high inflation, which was fantastic for multifamily. So multifamily, great hedge against inflation because as prices goes up, rents go up. And if you didn't underwrite rents that high, then your underwriting looks like it way overperformed.
Right.
Problem is that when you buy and inflation is temporarily spiked, then you're still building into your model more rent growth. And what we found was in 2022, not only did things flatline, they kind of reduced. So you kind of had two dynamics at play. You had really inexpensive debt, and you had a lot of competition in multifamily because office and hospitality, a lot of the institutional funds were flooding to multifamily because it was so attractive. So now that there's been kind of a leveling off and there isn't a lot of institutional capital in the market, you have, oh, so all of that cheap debt also created an environment where a lot of people were building multifamily. So those were the converging kind of factors. So
Yeah.
you have a softening rent environment with a historical amount of supply coming online, and that's what's caused a lot of the distress that
Right.
temporarily has reduced demand, whether it's from a rent growth perspective or a sales price perspective. Now, the good news is that a lot of that pain has already been realized.
Mhm.
And what I tell investors, especially in some of the deals that are facing adversity with us, is like you can't have it both ways. Like that pain that's hurting deals that are in our portfolio that are going to take a little bit longer than we expected is
Mhm.
also creating a lot of opportunity because these other people that are having to sell at this moment in time are dealing with soft rents. So you're able to today get a really good basis. And over 26, 28, and 29, they're talking about historically low supply coming online. So those same dynamics, it never goes one way forever.
Right.
Like it's going to kind of go like this. And we're at that moment where you've kind of gone over the hump. Things have gotten, kind of dicey. Some
Yeah.
people that didn't prepare or have contingencies in their business plans, suffered a lot. And now a lot of people and big institutional guys are all building up their war chests to attack the market today. And that's how we're looking at it.
Very interesting. So let me ask you this. Of course, most of the time, one of the key questions you would ask any sponsor is like what the sponsor is investing in the deal or whatever. And most people that are in your space invest as individuals as well. So, general rule of thumb for your own asset allocation, if you don't mind sharing, what level, what percentage range would you feel comfortable having in private equity syndications across the board, whether it's multifamily or another type of asset class? Versus whatever else, right? Equities, physical real estate that you personally own, etc.
Yeah, I would look at it as you forecast the different markets, like the same dynamics that we just kind of discussed in multifamily. So if you were asking me this question in 2016,
Mhm.
I would have been really heavy on multifamily and I wouldn't have had a ton of money in traditional equities. And in the traditional equities I did have, I'd have a pretty nice split where I was kind of, a little bit more aggressive in those and less risk assets like bonds.
Right.
Going out of COVID, I would have said reduce your portfolio in multifamily and some real estate because the market's looking really frothy. Cap
Yeah.
rates are way low. Like buying a 90s property in outside of Atlanta for a 3.8 cap is like unheard of. Like today, that same property is trading for a 6 cap. So in those types of moments, I would say shift. So it's like you're playing a game of like poker, where at some point you need to take some of your chips off because if you've found a ton of success somewhere and you feel like you've gotten towards the peak, like this is how I felt about the stock market 6 months ago. I was like, wow, the stock market's looking pretty frothy. Like maybe it's taking some of my winnings out of this and moving it into some other asset classes that have already gone through the pain and then that's usually how I spatially look at my portfolio, my personal portfolio like that, where it's like I follow trends enough to where I'm like, I've done really well here. It's not
Yep.
always going to be to the moon. Let me reallocate. And I
Yep.
think that's what sophisticated hedge funds, groups like this tend to do too. They don't leave the asset class, they don't leave the positions in their portfolios, they just shift them around based off of how they personally forecast.
So it's interesting. You're basically utilizing like the classic equities rebalancing strategy of selling off whatever's performed well, buying whatever's performed less well, but you're applying it to the broader asset allocation across all assets in your own asset base, which is kind of interesting.
Yeah.
Yeah.
With the exception of things that I think could be or are being majorly disrupted. So like
Okay.
I'm not out there buying Office right now, even though Office is selling at like 10 caps because I don't know I
Yeah.
can't forecast how Office is going to rebound without it being reimagined completely. So
Right.
if I don't understand how something is going to get back into its upcycle, then
Yep.
I will usually shy away from it until something unexpected happens. And then if I see value and I can see a growth trend coming in the future, I'll reallocate to those areas.
You make a great point on Office. Who knows what that will look like. Very interesting. Well, I think hopefully we've kind of covered the big picture of what it looks like to say, I want to invest in this type of deal, what it looks like from a cash output standpoint, what the logistics look like a little bit, and then what you would be looking for when choosing a sponsor or looking at a deal that's presented to you. We do have some time. We can hopefully take some questions in the chat, and then I would love to make sure we include information if anyone is interested in learning more about investing with you guys specifically at Viking Capital. What would be a good way to learn more from you guys too? So we'll definitely want those links, but it looks like we have a couple of questions here. Uh, Here's a good question. What options do you have to get out of a deal that's not going as you planned or projected?
Yeah, there really aren't. And that's one of those reasons why it's really important to understand the hold period
Yeah.
and the illiquidity aspect, because once you're in the deal, there isn't like a way to sell at a low point like with a traditional equity. You're really in it until the property gets turned around and then gets disposed of.
Yeah. That's one of the downsides, but realistically, that can also be a downside of even just like buying any physical real estate investment too. I mean, yes, you can list a property whenever you want, but whether or not the market will allow you to sell it at a reasonable profit or whatever is dependent upon a whole bunch of macro factors that you can't control. So it is a downside, but in some ways that exists in other forms of real estate investing too.
And in some ways, it protects you because your gut, when something falls in value, is like, oh my God, I don't want this anymore. And you get
Get
rid
rid
of
of it.
it. And
Yeah.
selling things at the bottom of the market is never the right thing to do, no matter
You
what.
make, you make a good point. Mackenzie asks, where or how do you find sponsors? Do you Google? Good question.
Yeah, I would say it's tough because a lot of real estate, even though in 2012 things opened up, a lot of really good real estate firms still don't publicly market. So a lot of it's word of mouth. It's working with some of the groups that, Viking's a group that promotes, like we go out looking for investors.
Mhm.
Not every group does that, but usually it's word of mouth, working with, friends and family that have invested in good deals, had good experience, referrals. And then you research, if you type in real estate private equity, multifamily sponsors, people will pop up and you can start the vetting process there.
Yeah, I would be cautious honestly on Google. I think the best way to do it is to like if you put yourself in groups where people are investing in syndications or other way, like you'll enter into conversations where people will tell you about their experiences and share names. I think that is honestly probably way easier and more likely to be fruitful when you go to have to vet the sponsor than if you Google. So I think the easiest answer is, are you in the right community circle? And if no one in your circle, virtual or in person, is an investor or is learning about stuff like this, it's going to be tricky. But the more you put yourself in community with people who are, names will just pop up left and right. And then you'll probably have, if not a personal reference, at least, like a chain of reference of, oh, my friend used this, my colleague used this, whatever group or whatever. It's more helpful that way. These are just easy deals to get burned. So you just want to be careful that
Yeah.
you're appropriately vetting.
And as you research, if you're not researching, if you're not, I wouldn't Google the sponsors to work with as far as like I want a multifamily sponsor as your keyword search.
Yeah.
But if you start looking into like how to evaluate a multifamily real estate deal, or you're actually like spending your time researching, learning how these deals
Yeah.
work, you
Yeah.
will find that the majority of reliable sponsors have thought leadership and education out there to help LPs invest better. And
Yeah.
typically the people that are creating that material are the people that you want to work with.
Yeah. Very, very good point. This is a good question. Do you know of any sponsors that will utilize funds from someone 1031 exchanging, I presume, into the fund from other real estate investments that they already own?
Yes, we do that. We actually have an opportunity right now.
Oh, really? Do you have a minimum amount?
Typically we would, but because this is a development deal and we do it through a tenants in common structure. So this one doesn't have, I mean, probably like 100K is like the
Oh,
lowest that we would be able to do.
okay.
Normal deal, we would still be able to do it, but
Yeah.
If it was a one-off and we were having to set up the structure for that one investor, it would be like a 500K minimum.
Okay, that's good. That's good to know. I've actually been told a seven-figure minimum before on that. So
Mhm.
that's a really interesting piece if anyone is interested in doing that. I think that's probably a relatively rare opportunity for you. Justina, what is the tax benefit of investing in syndication versus an STR and using the STR tax loophole?
Yeah, so this is, I would say it goes kind of in tandem. So the STR loophole allows you to kind of use passive in losses against active income. And what real estate syndications allow you to do is get your share of the depreciation from the asset based off of the investment amount that you put in. So the way that I would have you think about this is say that we're buying 200 unit property and we do our cost segregation study and it creates $10 million of passive losses. You would divide the amount of equity. So say $10 million is what's raised, and there's
Mhm.
$10 million of losses. Every investor would get a $100,000 loss on their K1. And that K1 would be able to be used against any passive income you have, which is the income you get generated from your short-term rental. And if you've successfully maneuvered the short-term rental loophole, in many cases, that passive income would also be able to be used against your active income. You want to consult with a strong CPA to help validate, some of this theory, because I've seen it. Some CPAs agree that you can or that you can't. But at the very least, I can assure you that the depreciation that you get can be used to offset any other passive income, including the income you get from that investment,
Yes.
which anytime you have the opportunity to grow your money tax-free, even if
Mhm.
it's for a short time until you recapture it 4, 5, 6 years down the road, it's money that's being left on the table without that
Yeah.
strategy.
I would also add, Justina, using this in tandem with the STR thing, you'd have to talk to a seasoned CPA, but it is pretty commonly utilized if one spouse has real estate professional status. That does allow you to take all those passive losses and offset active income, and that's probably less controversial. So if that's your plan, is for one high income W-2 to work, the other one to claim rep status, syndications can be super helpful in that regard as well. Okay, what happens to your syndication if you pass away? Can you create a beneficiary like for any other investment?
Yeah, we actually had this recently, unfortunately, and it takes proper planning where you just want to make sure that you've recognized it in your estate planning. Um, and whether it's in a will, the way it works for us is assuming that your interests in the project don't end up in probate and there's an executor of the will or the trust and
Right.
they come to us and say this has been left to this person as a beneficiary, then we can actually work with them to change the ownership and go directly to them. It gets more difficult if it ends up in probate and there's no clear direction for what the property is supposed to do. We aren't able to just get a phone call and be like, oh yeah, we'll just change the documentation. It doesn't
Right.
been properly planned for, but great question. And yes, it when properly done, it can definitely be passed along. What's really great about passing along investments that accrue interest is in many cases, what a lot of people do is they continue rolling these investments forward and growing and doubling that money, offsetting taxes. And when you leave it to the next generation of folks in your family, they get it on a stepped-up basis and they never pay any of the taxes that would have normally gotten recaptured. And that is what most people that are legacy planning with multifamily investments do is they build a strategy knowing that they're never going to use these returns and it's going to go tax advantage to the next generation of their family.
Yeah, Caitlin, and I would also add a lot of people invest in syndications through LLCs. And so if you do have an asset protection or estate planning attorney you're working with, it might be as simple as making sure that that LLC then passes through to your trust, which of course would avoid the probate he's mentioning. So it's a pretty easy way to make sure there's a flow through into your estate plan. But if you have someone that's doing that structure for you, it would definitely be something to run by them, whether they're asset protection or estate planning attorney. Okay, Kyle, where can I get more information on how to screen deals or gain more education?
Yeah, I mean, you're welcome to come to our website. If Kristen's going to give our
Just put it in.
information Yeah, like anyone that comes to Viking Capital and wants to learn, we have an amazing library of deals. We built an investor toolbox that literally goes through a glossary of terms, explains everything from A to Z. Every time we launch a deal, I personally do a performer review where I go through every line of the perform and explain how it all works. And there's lots of resources, but we do a lot of investor training in our company.
Perfect. And we have one last question in the Q&A from Justin. When does investing in a real estate syndication fit into the wealth building journey?
Great question. So I don't know that there's an easy answer, but my personal opinion of how this should work is usually when somebody has some amount of excess capital, you will always make more money putting in your capital and your sweat equity into whatever you're doing. So you usually want to take whatever excess capital you have and whatever available bandwidth you have and combine that together to maximize your returns. Once you've hit that threshold where you're like, I don't want to do this anymore. I don't have time to manage more than the three short-term rentals I already have. And you've learned a little bit about how hard it is to manage a property. That's usually when I would say the best time is to look at doing things passively because you understand the business a little bit. You understand that you don't want to be in the business that much. And you're now leveraging your money to buy back your time, which is an even bigger benefit than the returns that you're getting.
Sure.
So that's usually how I coach folks. People that this is the biggest question that I get asked is when should I consider doing this? And I think that that's always the answer.
I like that answer. I'm going to add some extra to it. Of course, you have to be accredited. And so it depends on what profession you have. If you are a medical profession that is inherently below those income thresholds, then you're looking at net worth, right? Which is going to be a little bit further down the line. Also, you need the capital to deploy. And so if you are like, a fresh new graduate with 6 months of clinical experience and you got 15 grand to your name, these things are off the table, right? And so you kind of have to get yourself into a position where you have adequate cash reserves, you have your high interest debt handled, obviously not your student loans, but you have your high interest debt handled. You feel like you understand a little bit about the world of investing and you're able to meet some of these criteria to really be accredited. And so in our world of working with medical professionals predominantly, PAs, NPs, and pharmacists, this is rarely something for like somebody in their first few years of practice, but it can be a really cool wealth building modality for somebody who's a few years out, they're established financially, and really wanting to diversify their asset class base without having to take on the work. Because let's be real, owning any property is work, whether it's a long-term rental or a short-term rental. So I would throw that out if you're happen to be a fresh grad listening, maybe table this for a few years. But if you've been in practice for 4 or 5 years and you're on a strong financial footing, it can be a really nice diversification move.
Yeah, and if you find yourself in that first bucket where you're not hitting the accreditation thresholds and you need a few years to kind of build up some of your net worth to be able to participate, it's never too early to start learning
Sure.
and finding sponsors and building relationships with them. Any of the good ones wouldn't mind you being in their network and learning and asking questions in preparation for when you are able to make those decisions and you're prepared for them.
Yeah, and the more deals you look at, the less it will feel like mumbo jumbo. And then as soon as you're eligible or ready to roll, you'll be able to look at the stuff and feel like you really understand it, which will give you a leg up ahead of other folks. So well, this has been awesome. I put your vikingcapitalllc.com in here. If anyone wants to go check out your website and learn more, is there anything in particular on your website or some specific way if someone just wants to like be on an email list or something to hear from you guys? What would be their first move on your website?
Yeah, they can go on there and I think they call it like an investor club or something like that. You join that and you'll be on our list. You'll get all of the deal flow, all of our newsletters and things like that. I think my information, my personal email is on, or my work email rather, is on the website. So anyone that wants to reach out to me directly and has any questions or wants to chat, I'm always available.
Yeah, I highly encourage you to do that. If you have an interest in syndication investing, just being exposed will teach you a lot. And so I highly encourage you to go join the email list so that you can learn the lingo, get yourself familiarized with the landscape, and feel more confident when something comes up that you're potentially interested in. So I'll throw that out. But thank you so much, Kris, for joining us tonight, for teaching us all of the stuff that you have so far on syndications. I know anyone who came feels a lot more confident with this type of investment process than they probably did an hour ago. So
Oh, well, thanks so much for having me. I really enjoyed the conversation, and hopefully we can do more stuff together.
of course, of course. Well, hopefully you have a good rest of your night, and we'll talk to you soon.
Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.